Okay, y'all, it's Tanya. We are here with lesson 6. I'm going to go over some lesson 5 stuff, which we learned were about swing highs, swing lows, higher highs, higher lows, lower highs, and lower lows. Um, and so we're just going to go over that a little bit. So swing highs are local hilltops, and swing lows are local valleys, which means it's basically a high number until you get to a turning point that has it descend downwards, and then a swing low is the lowest number that swings around and starts changing directions to go up, and that's the local valley. Higher highs is when the currents or the new swing high is higher than the previous swing high. That makes it a higher high. And then higher lows is when the new swing low is higher than the previous swing low. And then lower highs is when the new swing high is lower or less than the previous swing high. And then lower lows is when the new swing low is less than the previous swing low. All right, so I think that, and then sideways, range, and consolidation are all used interchangeably when you're talking about market structure. But it just basically means that you can't really tell if the price is trending upwards or downwards. And an upward trend means that we have higher highs plus higher lows, and a downward trend is we have lower highs plus lower lows. And then a pullback is a temporary move against the current upward move trend. So if we go from 10 to 14, then we come down to 13, we pulled back a little bit, and then we go to 17 and we shoot back up. All right, and then a reversal is when we're trending upwards and then we reverse and start trending downwards. All right, so that is our review for lesson 5. So let's go ahead and move on to lesson 6. So lesson 6, we're going to be learning about support and resistance. And just before we start, I don't give financial or legal advice. I'm not even teaching you. This is how I teach myself. If I can talk about what I'm talking about, I know what I'm talking about. Let's see, is that it? Not selling any ebooks, no courses. And if you happen to learn something along the way, that's great. If not, that's cool too. Thank you for your support. All right, so let's go ahead and jump in. So now that we understand swing highs and swing lows, all right, this is going to help us as a beginner. We won't be so focused on just looking at green candles and red candles. We'll be able to start looking at different areas and focus on different areas that will help us enter into the market and jump out as well. So today we want to understand that support and resistance are areas where market participants have previously reacted. So we get to a certain area, whether it's high or low in price, and it either starts decreasing every time it gets to a certain area or a certain price range, or it starts increasing every time it gets to that certain price range. That's what support and resistance is. And we're going to get a little more deeper into that. Now, they're not magical lines that force the stock to move. So it's not like, let's say 50 is a support or a resistance, and which is basically an area that forces the market to react, or participants have, it doesn't force, sorry. It's basically an area where participants have been known to act previously before. But it's not a magical line where it's like, okay, it gets to 50, this is the area or the range, and it gets to 50 and it automatically reacts every time. That's just not true, because remember, we're dealing with probability. We don't know what anybody else in the market is going to do, right? We're just going based off of the context and the information that we have and making an educational guess. All right, so by the end of lesson 6, you'll understand what support is, resistance, zones, tests, breakouts, false breakouts, and role reversals. That's our vocabulary for lesson 6. All right. Now, imagine TJP is trending here. It goes from 12 to 10 to 13, right? So right here in this area of 10, what is it doing? It goes up to 10. Goes down to 10 from 12, and then reacts here at 10 around this area and then start shooting in the opposite direction. And remember, this brings us to swing lows because it went from 12, went down to 10. 10 was our turning point where it started changing directions and going back up. So 10 is also a swing low. And remember, we learned that back in lesson 5. All right, so I'll just note that here. All right, so we know here that 10 is a swing low. But now suppose later, once it got from 13, here at 13, it went to $10.10 and then shot back up to 14. So as you can see here, it went from 12 down to 10 and then shot back up to 13. We know that 10 is a swing low because it got to 10, it decreased down to 10 and then swung around to start going up. So 10 was our swing low here. And then after that 13, it shot back down to around 10, in the range of 10. So not specifically at 10, because remember, this is probability. The market doesn't react the way that we want it to react. So in a range close to 10, it goes back down close to the area of 10 and then shoots back up to 14. So that we know right now, okay, participants in the market previously reacted to 10. They got down all the way to 10 and then they shot back up. So now we're looking here that we got all the way back down to around 10 and we're shooting back up to 14, all right? And then later, say we go from 14 to 9.95 and then shoot back up to 15. See, we're still back in that range of 10. It might not be directly on 10 because remember, the market does not react the way we want it to. But see here, it's every time it's shooting down to around that same, shooting around to that, sorry, I got a message. But every time it's starting to shoot down around that same area and react, all right? It keeps attracting it keeps attracting a reaction around the same range, around 10, all right? And remember, it's not going to be a specific amount. It's not going to be a specific price, okay? So, but we might identify this reaction or this area of 10 as a potential support. And when we think about support, we want to think about support as a floor. When you think about support, you're standing on a floor. You're not going to go below that floor, okay? Now, support is the area where price has previously had difficulty continuing downward. So see, we get to 10 or we get around the area of 10 and it won't go any lower around that range. Remember, it's not a specific number. Around that range of 10, it won't go any lower and it reacts and starts going back up. So support is an area where price has previously had difficulty continuing downward and buying interest, or in other words, demand, supply and demand. So buying interest and demand has been sufficient to produce a reaction going upward. So meaning like people are really wanting to buy. The demand of this stock is making them reach a certain area and reacting to going back up, driving up that price again. All right. So again, we want to think about the floor. When we think about support, think about the floor because that's the lowest area that the market is willing to trend downward to, and then it sends a reaction back up. It's making participants get back in and rise or raise that price back up. All right. So support is floor. It's a swing low, floor, support. Think of all of that as the floor supporting you, and the floor is low, which makes it a swing low. All right. Now, remember, I said that the market does not react the way that you want it to react. So remember, this is just the area of potential for you to look at. It's not really for you to make a decision on. It's just for you, it's to look at that area and pay attention, because remember, support can break. The floor can break from underneath you. Prices can always drive down. Remember reversal? You can have a pullback, but then instead of it shooting back up, it could just start declining downwards. So remember, it's not anything magical. All right.